Today I want to go over mortgage payments as a whole, what they consist of, and which parts are flexible. This video may seem relatively simple for veterans in the industry, but can be pretty valuable if you're a first-time homebuyer or new to real estate in general. Many people think that interest rates determine what your mortgage payment will be, and while they do determine a part of that payment, it doesn't tell the full story. Mortgage payments consist of several different parts, and the amount of each part can vary depending on the borrower's circumstance, the loan type, and several other factors. Let's start by covering the basics: principal and interest, also known as P&I. Your loan amount, interest rate, and amortization schedule will largely determine what the principal portion of your payment will be. If your loan amount is larger, you will pay a larger amount towards the principal each month. Also, if your mortgage is scheduled to be paid off in a shorter period of time, such as a 15-year mortgage versus a 30-year mortgage, you will have to pay more towards the principal each month in order to hit that goal. The next portion of your payment is the interest payment. The interest rate is the annual percentage charged for borrowing the money. Since mortgage payments are paid monthly, the annual interest amount is divided by 12 to get the monthly payment. Obviously, the higher the interest rate, the more you will pay in interest each month. This covers the P&I part of your monthly payment, but there are two more parts: taxes and insurance. These two sections together form an acronym called PITI, P-I-T-I, principal, interest, taxes, insurance. Moving on to taxes, property taxes are determined by local government authorities. They're based on the property's assessed tax value and the jurisdiction's tax rate. To calculate property taxes, the assessed value is multiplied by the tax rate. For example, if your property has an assessed value of $200,000 and the rate is 1%, your annual tax amount will be $2,000. $200,000 times 1%. You would then divide this number by 12 to get your monthly tax payment. The last part of PITI, or PITI, is insurance, which is the most complicated part of the payment. You know it's bad when taxes are less complicated. There are a few types of insurance that fall under this category, but the two general types are mortgage insurance and homeowner's insurance. Mortgage insurance is applied when the borrower is coming in with what a lender would consider to be a more risky loan scenario. For example, conventional loans have mortgage insurance anytime the borrower is bringing less than 20% down. The more money a borrower puts down on a conventional loan, the less amount of monthly mortgage insurance is required. But the good thing about a conventional loan is that the mortgage insurance will go away automatically once 20% equity is acquired in the property. And it doesn't matter whether you pay that down to 20% equity or the value of your home increases to the point where you automatically have 20% equity, that mortgage insurance payment will go away. FHA loans are always considered by the lender to be a riskier loan situation, so they will always have mortgage insurance on the loan. The monthly mortgage insurance amount on an FHA loan can only be removed with a refinance, making FHA loans great for getting your foot in the door, so to speak, but in my opinion, aren't the best option for sticking with for the long term. Now, homeowner's insurance, which is different from mortgage insurance. This will be determined by mostly you in tandem with your insurance company. Your homeowner's insurance amount will be determined by your deductible, your credit score, your claims history, your home value, and other factors. But overall, this is to say that the interest rate only determines a portion of your monthly payment, and we can look at a practical example now. With a home valued at $400,000, if you brought a 5% down payment, this would be a loan amount of $380,000. The P&I, principal and interest, portion of your monthly payment in this case would be $2,400. Because taxes and insurance can be so variable and case by case, I will use round averages for this example. Taxes in this example would be roughly $170 a month, your mortgage insurance would be roughly $120 a month, and your homeowner's insurance would be around $85 a month. This would leave the total monthly payment at $2,775 a month. Now, let's say the interest rates drop an entire percent, from 6.5% down to 5.5%. The principal and interest portion of this payment would be $2,150. But everything else would remain the same, and your total monthly payment would be $2,525. So in this example, interest rates coming down 1% saves $250 per month. Now, I'm not one to scoff at $250 a month, but considering the total payment, this is only a decrease of about 10%. So, the big question, do you wait for interest rates to come down before you purchase? Or do you purchase and when they come down, you refinance? Buying real estate and timing a purchase is an entirely personal decision, and there is no perfect solution. Every decision made in real estate has some sort of pros and cons, and with this complicated of an industry, there will always be some type of trade-off. Making decisions in real estate is risky, but I think that not making decisions in real estate is even riskier. Ultimately, the decision's up to you. I'm just here to educate and facilitate so that you can make the best decision for yourself. Remember to hit like and consider subscribing. If you have any comments or questions, drop them in the comments below. And if you want to contact me directly and work with me or just even set up a free consultation, you can click the link in the description and send me an email. Anyway, I'll see you guys next time.